Walmart shares falling more than 5%. It's the biggest drop that we've seen since November of 2023. You're now looking at losses actually of just about 6%. Now the stock under pressure following the retailer's full year guidance that fell short of the street's expectations, and that cautious forecast raising some questions about the resilience of the U.S. consumer. Joining us now, we want to bring in Oliver Chen. He's TD Cowen's a senior research analyst. And Oliver, there is a lot to unpack within these results. Let's just first start with the stock reaction here. You're looking at losses of just about 6% at the open. Is that justified to you?
Well, the big story here is the PE multiple is very high at Walmart. It's 38 times versus a 3-year average of 24 times. So expectations have been very high as this stock's really worked well. What's really happening is the guidance, and people are responding to the guidance. The guidance is a little softer than street expectations. However, we're encouraged that this is conservative and in line with the past in terms of how Walmart guides. And this was a solid quarter, a very stable consumer they're seeing. General merchandise was up low single digits, second quarter in a row for this to happen. Also, general merchandise unit sales were solid, and the comp was better than expected for the quarter. So the stock is weaker on both valuation and guidance. That being said, this company is hitting on all cylinders, including low prices plus technology, digital advertising, and the marketplace model.
Oliver, we know they had something to say about tariffs. We know that you're running the calculus around what this will mean to the business. What is your kind of early estimation about any headwind that could apply to Walmart?
Yeah, part of the guidance is just commenting on this very dynamic environment. So what's going to need to happen is some will be passed through to consumers and some will be eaten by companies in the form of margins. That being said, Walmart is a real leader in rollbacks or discounts or negotiating with suppliers. It also has a more modest percentage of exposure to imports than Target and some others. So those are things that we like, and bigger is better. We think cash is king, and owning these bigger retailers that are executing globally, it's a great place to be.
Oliver, when you take a look at the impact that this is even having on its competitor Target, when you take a look at some of the dollar stores that are lower this morning on the back of these results, I guess, how do you see those spending trends at some of their competitors comparing to this, and whether or not this is a signal maybe of more of that weakness to come?
Yeah, I think we're going to see cautious optimism with lots of cross currents. The story for retail this whole past year has been winners and losers too. And as you think about Walmart, they're executing so well on the supply chain, on curbside pickup, on delivery, on AI. It's really hard for everybody to do this. So they're outpacing others. They're taking share from dollar stores, particularly because Walmart's offering low prices plus lots of convenience. In addition, they're getting higher household income customers. So I think you're going to see winners and losers. It's going to be very difficult for companies to inflect this year, given this cautious optimism, and it won't be winners around the board. We'll see. The consumer still being considered in their purchase, looking for strong values and looking to consolidate, and still focused on needs. A little bit of inflation too, 1 to 2%. It should be normal, hopefully, but some spikes in certain areas like dairy too.
Oliver, you got a lot of people lighting up the Yahoo Finance platform, perhaps using some of those charting tools and looking at moving averages here today, trying to figure out whether or not it's safe to buy Walmart on a pullback like this. What is your evaluation?
We're encouraged. However, I would say as analysts update their estimates overnight, given that it was lower versus street by about 8%, people do have to revise their estimates to this new bar. That being said, this company is consistent and the consumer is consistent. So it's well positioned for a beat and raise, and we certainly like it for the longer term. The other thing to pay attention to, of course, is alternative revenue streams, meaning digital advertising and the marketplace model. As you think about the third-party marketplace, there's only 700 million SKUs at Walmart. There's about 5 billion at Amazon. Also, digital advertising is a big growth opportunity, particularly as the marketplace grows too. That will help margins grow faster than sales. And this retailer has over $9 billion of cash as well. So you're getting a lot of great characteristics, but the near-term estimates need to become a little bit softer. So we'll see.
Oliver, is that going to be enough to offset then some of that weakness if we do see any sort of weakness related to tariffs?
Yeah, I think that tariffs will be something to watch. It's so dynamic, and the consumer and inflation and circular issues in terms of how this pressures consumer confidence. But what we are thinking is there's a real barbell opportunity, meaning we upgraded Cartier and Richemont. We're seeing the wealth effect at the very high end. And then these retailers that can execute to exceptional value, low prices, rollbacks, they will be better positioned because customers will trade down into places like Walmart to get that everyday low price. And that's great across all cohorts. At the same time, you don't even need to go into the Walmart store to experience this. The marketplace, curbside pickup, and those are very expensive operations to run. Walmart's doing it better and better with more profitability on e-commerce. That's another positive too. But it's not a cheap stock, 38 times PE. You can't forget that. We have a buy rating. We like it for the long term, and we like this whole flywheel between technology meets value meets grocery leadership.
What does that mean for the luxury end that you were just talking about a moment ago here? Because you do have a lot of luxury brands trying to figure out how they can go unscathed from tariffs that might hit their business, thinking about some of the European brands, some of the international brands that sell into the U.S. luxury consumer right now, and all the deal making that's also started to take place. Yesterday, we saw two, I think, big deals, at least in my mindset, that are going to change the aisles that people shop in. And Stuart Weitzman going to, what is it, I forget the name. But anyway, some of the big deal making that took place in luxury yesterday as well.
Yeah, Brad, luxury is going through a lot of change. There's a lot of industry consolidation in luxury, so the biggest players are quite large. Our pick here is what hard luxury is working, meaning jewelry, gold, and aspects of rings and diamonds. The real beneficiary there is Richemont. The big caution for luxury is China, and China's housing market, as well as this dynamic situation between the U.S. and China, is impacting consumer confidence and spending in the real estate market. The big winner in luxury is the U.S. market, and the wealth effect and the resolution of the election happening added a lot more confidence. That's a nice positive for what we're seeing with spending patterns at the high end. Lots of changes, though, creative changes in terms of at the major fashion houses, and we're still in a bit of a boring, quiet luxury phase where people are yearning for more fashion. So a better picture probably in the back half, but mixed in luxury, you have to be pretty selective. U.S. better, wealth effect, consumer confidence, the last 12 months of S&P 500, those are all positive for the higher end.
Caleres was the word I was trying to remember, Oliver, and Stuart Weitzman, Caleres deal. Yeah, just wanted to clarify that for our viewers. Oliver, it's always a pleasure to grab some time with you and get your analysis. Appreciate it.